People always ask me the difference between the mortgage contingency and the funding contingency. Both brokers and clients are sometimes unaware of the discrepancies or the differences, so here they are. A mortgage contingency essentially means your first safety net. As a buyer, you have 30 to 45 days typically from the time a contract is signed by all parties to get a commitment from your lender. That commitment from your lender will have certain conditions for you to meet in order for them to actually give you that money. So a commitment can say, yes, we're going to loan you this $1 million, but we have to verify that you're still employed, that your 2023 taxes show X, that you move $200,000 from this account over to the account at our bank. Bunch of different conditions, very standard. Once that commitment is met, the mortgage contingency is met, so long as a satisfactory appraisal comes out. The second safety net is something called a funding contingency. That's for way later to protect you. What that typically does is if the bank says yes and they issue you a commitment, but a week before you close, the bank takes another look at the financials of the co-op or the condo, and most times this has nothing to do with townhouses, it's really just the co-op or a condo, and they find that the financials have really gone down the tubes and the insurance that they have is insufficient, or the bank's just saying, hey, look, we're taking a much stricter line on these types of buildings, and they say, unfortunately, we cannot lend you this money. The funding contingency protects your deposit. With a standard funding contingency in the contract, if the bank says, hey, we can't lend as a result of the building, then you get your money back. This differs tremendously from a funding contingency that is based on your personal financial circumstances. In plain English, that means if you lose your job, in most funding contingencies, that won't protect you. Your deposit will be on the hook. But in a situation where a building's financials go haywire or something happens, you saw this after Hurricane Sandy and a number of other sort of issues, you're able to get your money back. So the differences between one and the other hopefully are clear. One happens 30 to 45 days after a contract. One runs all the way through to the closing itself, right? One is based on both you and the building. So if a bank says no to a mortgage commitment because your financials are not great, no questions asked. You still get your money back in most situations. If a building says it has bad financials and the bank says no at the end of the day, a funding contingency will protect you there. Hopefully this helps.